Okay. So now let's try to understand the liquidity ratios. So liquidity ratio simply tells you that how much liquid money you have so that you can use it into the business operations. One of the important liquidity ratio is the current ratio. So to calculate current ratio, we need our current assets and we need our current liabilities. Current assets are those assets primarily which gets converted into cash or cash equivalents within a year, and current liabilities are those liabilities which you need to pay at least within a year. So if we go to our balance sheet and P&L, so this is our balance sheet here, and within our balance sheet, our current assets, we are having these three current assets, which is cash and cash equivalents, accounts receivable, and inventory. So $250,000 is our current assets. And if we go to our current liabilities, we are having two current liabilities here, which is accounts payable and short-term debt. So $100 totality is our current liabilities. If we go to our example here again, so 250 was our current assets, 100 was our current liabilities, meaning our current ratio is 2.5. Now this simply signifies that for every $1 of current liability what you are having current assets of 2.5. So this is a good sign that you are having lower liabilities and higher current assets. Now, why do the companies use this particular ratio? So the company wants to see whether they can pay their short-term obligations or not, because this takes into consideration the current assets and current liabilities both. If the ratio is more than 1, then their company is having more current assets, which means it's safer. Just like in our example, company was having 2.5 of current ratio, which is like it's more safer. And if it's less than 1, which means that company's current liability is higher and current assets are lower, so the company is at a risky position. Similarly, this helps the vendors, lenders, and other people to see how is the credit wealth of the company as well. Now the management can also decide based upon it that where they need to plan their cash if they are having higher current assets. So the current assets is the I can say cash is the component of the current assets, so they can plan on that. They can plan on the working capital, that how much working capital they need, and they can plan for short term financing if like they need certain money in their bank account as well. Similarly, industry benchmarking can also be done, like you can compare the other FMCG sector or retail people who are in your same industry and what is their current ratio. Similarly, manufacturing industries can also be used that. Now let's see the real world example. So generally if we see the case of Walmart, so the current ratio for Walmart is generally below 1, which is 0.8 to 0.9. Now this looks risky at first, but what happens is like Walmart generate cash daily from its sales, so it doesn't need a high current ratio, because the Walmart is not having so much of I can say debtors, because their main cash sale is the cash sale, so the sales are not on credit. So if the sale is not on credit, there won't be any debtors or much debtors, and if there won't be any debtors, the current ratio will itself be lower. So this is a good sign for Walmart. If we see the Apple company, so the current ratio for Apple is also 1 to 1.2 in recent years. Now this is enough to ensure that the company can pay its short-term obligations. And the Apple company is a cash reserve company because they are having a very strong brand and they are having a large amount of cash, so they don't have any risk within this change of this ratio. Similarly, if we see the Ford or General Motors company, their current ratio falls within 1.2 to 1.4 many times. Then automobiles industry requires more working capital because cars take more time to sell. Now the cars, if not selling, they are sitting within the inventory of that General Motors, and if they are sitting within the inventory, then the current asset will increase, and the current asset increase, the current ratio will increase. And lastly, the utility companies, often we see that the low current ratio 1 point less than 1, because they have predictable cash flows from the customers, so lenders are not worried. Generally the electricity companies and utility companies, they don't have very much debtors because they have monthly cycles, and within that monthly cycle people will be paying their electricity charges and so on. So there is high predictability, due to which lower debtors are there, and due to lower debtors, lower current asset is there, and due to lower current asset, lower current ratio is there. So this is the usage of current ratio.